Welcome to Curious Commerce, Part 4, Introduction to Financial Management. Objectives of Financial Management: the wealth maximization, profit maximization, to maximize earning per share, to minimize the cost, to minimize the market share, to maintaining liquidity, ensuring long term sustainability. The main objective of financial management is wealth maximization. This means the aim is to increase the value of company and increase shareholders' wealth. Profit maximization is also an objective, but wealth maximization is more important because it considers long-term growth and sustainability. Financial management also aims to maximize earning per share. When the earning per share is increased, automatically the agency problem will be minimized. We discuss agency problem in upcoming classes. And minimize cost. When the minimized cost will be takes place, automatically the profit maximization will be possible. Expand market share. When the market share expands, automatically the mass production will be takes place. It directly correlated with the minimize the cost. And maintain liquidity. The liquidity nature is very important for every business and ensure long-term sustainability or survival of the business or the artificial person. The simple example: when a company reinvests profit wisely and its share price increases, automatically shareholders' wealth is also maximized. For example, Reliance Industries focuses on long-term wealth through diversification from refinery to retail and petrochemicals and telecommunications, etc. All the objectives are interconnected. When liquidity is more, it is easy to diversify in the market through the diversified product. When diversification will take place, automatically possible to maximize the market share. When the market share increases, automatically the minimize the cost will be takes place. When they minimize the cost takes place, the profit maximization will arise. When profit maximizes arise, the maximize the EPS. When all these things arise, the final result is the wealth maximization for the shareholders. Basic axioms of financial management. Cash flow should be preferred over accounting profit. Time value of money should be considered since today's rupee is worth more than tomorrow's rupee. Risk return trade off should be considered since additional risk is to be compensated by additional return. Incremental cash flow should be preferred over a total cash flow. Taxes bias business decisions. Imperfect capital market bias business decisions. Financial decisions must consider certain basic principles. Cash flow is more important than accounting profit because cash supports daily operations. For example, Jet Airways had profit on paper but no cash. The company collapsed. The time value of money states that today's money is worth more than the same amount in the future. Today's 100 rupees is not equals to tomorrow's 100 rupees. The thing we called as in the present value and the future value. We discussed the present value and future value concepts in next class. The risk return trade-off states that higher the risk should be rewarded with the higher return, but practically it is possible. Only on the basis of the certain financial decisions it is possible to take the higher risk and the higher return. Or in another word, with calculative higher risk, it is possible to get the calculative higher return. Incremental cash flows should be analyzed instead of total cash flow. Taxes and imperfect capital market. The markets we classified into two category units: perfect capital market and imperfect capital market. We discuss one by one in the next class. The taxes and imperfect capital market influence financial decisions and can change the outcome. For example, if you receive 1,000 rupees today, it is more valuable than the 1,000 rupees what you received will be received in the next year because you can invest it and earn interest. When the tax changes, automatically your actual return compared with the expected return will be changed. If the market condition changes, automatically it reflects on or it creates the difference between the expected and the actual returns. The three major financial management decisions are the investment decision, financing decisions, and dividend decisions. But what about the interrelationship with the investment, financing, and dividend decisions? Investment decisions focus on selecting profitable projects. The financing decisions focus on deciding how to raise funds through equity, debt, or retained earnings. Dividend decisions focus on how much profit should be distributed to shareholders and how much should be retained for growth. It means that the balancing profit and shareholders' return. These three decisions are interconnected because each decision affects the value of the business. For example, if a company invests in a profitable project, that is the investment decision, it must decide whether to use debt or equity, that is the financing decision, and the dividend payment or the profit level and how much profit should be distributed to the common shareholders may reduce the amount availability for reinvestment. It means that there is the dividend decisions. All three decisions impact firm's value. That's why the each and every decisions, investment, financing, and dividend decisions are interconnected. If you're changing in the investment decisions, automatically changes in financing and dividend decisions. If any changes in the financial decisions, automatically changes in the investment and the dividend decisions. When you take the different type of the dividend decisions, automatically changes in the investment and the financing decisions. All three decisions impacts firms' value. What are the functions of a financial manager? A financial manager plays a very important role in the company. He estimates how much capital the business will need. He decides the best sources of finance and manages the capital structure. He makes investment decisions and ensures funds are used efficiently. He also manages working capital and cash flow. He makes dividend decisions and ensures financial control through budgeting and reporting. In one statement, the major function of the financial manager is to adopt proper decisions to minimize the agency problem through the profit maximization and wealth maximizations and minimize the agency problems with all the stakeholders. For example, the chief financing officer of a company decides how much money to borrow, where to invest it, and how much dividend to pay. The three areas: one is how much money to borrow, how much amount borrowed from the bank, or how much amount borrowed through the debt instruments. After that, the borrowed amount, where to invest it. So, in that investment, he should consider what is the return level, what is the expected return, and what is the forecasted actual return will be, and how much dividend to pay. It means that after investment, the profit will be arise. Out of that profit, how much amount or how much of the percentage of the profit should be distributed to the shareholders and how much out as a the retained earning. So these are all the major functions of the financial manager. Stakeholders of an organization. Stakeholders are individuals or groups that are affected by the activities of the business. Investors, generally we call as in the shareholders, provide funds and expect good return. Employees work for the company and expect fair wages and job security. Lenders, generally the financial institutions or the banks, expect timely repayment of loans. Suppliers, or provide the raw materials, expect timely payment for goods supplied. Customers expect good quality service and fair prices. Government expect companies to follow the rules and regulations of the government and pay the tax. The public or the common man expect business to act responsibly and contribute to society. For example, when a company pollutes the environment, like the textile or certain chemical industries or petrochemical industries or pharma industries, therefore they are facing the problems from the common public. When the company pollutes the environment, they violate the rules and regulations of the government. The public becomes negatively affected. This shows how public is also as a stakeholder played the major role. In the case of the stakeholders, any misunderstanding will be arise because of not followed the rules and regulations of the government or not paid the tax or the quality of the product is not good or they are not paid the interest to the lenders or the banks or they are not satisfied the investors through their profit, automatically the agency problem will be arise. It means that the conflict between the stakeholders, the major stakeholders of any organizations or six members is the investors, lenders, public, government and their agencies, customers and suppliers and other trade creditors. So if any misunderstanding will be arise, automatically the agency problem will be arise. As a financial manager or as a financial management, the objective is to minimize the agency problem with the all the stakeholders. Now we will discuss on cardinal principles of financial management. Cardinal principles are the fundamental guidelines that help a financial manager make correct and effective decisions. These principles act like the rules of the road for financial management. Let us understand each principle one by one with simple example. The first one is the strategic principle. This principle says that financial decisions must support the long-term goals and visions of the business. Every financial action must be aligned with the company's strategy. For example, if a company's long-term strategy is to become a market leader in electric vehicle, then finance must support R&D. It means that the research and development, technology upgrades, and capacity building. Second one is the optimization principle. This principle states that finance must be used in the most efficient way. The goal is to get the maximum benefit from every rupees spent. For example, a company must choose the most cost effective supplier to reduce production cost without reducing quality. That thing we called as in the optimization principle. Third one is risk return principle. This principle explains that the expected return should be equal or higher than the risk taken. Higher the risk should provide higher return, and lower the risk will give lower the return. For example, investing in shares is riskier than the fixed deposit in bank or post office. Therefore, the shareholders are expected about the higher returns, or shares are expected to give higher returns. The fourth one is marginal principle. This principle says that a financial decision should be taken only if the additional benefits are greater than the additional cost. Once again, I will repeat, financial decisions should be taken only if the additional benefits are greater than the additional cost. Businesses should think about the extra gain, not just the total gain. Whatever get the addition from the additional investment. For example, a factory should install one more machine only if the extra profit from production is more than the cost of the machine. The fifth one is sustainability principle. Financial decisions must be suitable to the nature of the business and the situations. Different businesses require different type of the finance. For example, a software company may not need heavy machinery, so it will spend more on talent and technology. But and a manufacturing company needs more money for machines and factories. It means that different businesses require different type of the finance for sustain. Sixth one is flexibility principle. This principle states that the financial plan should be flexible enough to adjust to changes in the business environment. Unexpected opportunities or challenges must be managed. For example, if interest rates drop suddenly, the company should have the flexibility to refinance its loan at a lower rate. The next principle is timing principle. Timing is very important in finance. Good financial decision must be taken at the right time to get the best result. For example, shares must be issued when the stock market is performing well so that the company can raise more money at a higher price. The next principle is roughing back principle or retention principle. This principle says that a part of the profit should be retained in the business instead of distributing everything to shareholders as a dividend. Retained profit helps the company grow and reduce dependency on external borrowing or external funds. For example, Infosys keeps a portion of its profit for expansion, new projects, and technology upgrades. When they maintain the retained portion for the expansion activity or for the new project or for the technology upgradation, automatically the dependency for the external financing is minimizes. All these cardinal principle helps a financial manager makes smarter, safer, and more profitable decisions. They ensure that funds are used properly and the financial health of the business remains strong.